Consolidation patterns. In this lesson, we are going to cover one of the most important concepts in SPY trading, understanding consolidation patterns. Consolidation happens when SPY trades sideways instead of moving in a clear upward or downward trend. During this period, buyers and sellers are relatively balanced and volatility often decreases as the market pauses. Many traders make the mistake of viewing consolidation as a boring or unimportant market condition. However, consolidation is often the preparation phase before the next major breakout or breakdown. There are several common types of consolidation patterns that traders should recognize. The first is a sideways range. This occurs when price moves between clearly defined support and resistance levels. The market is not showing a strong direction, and traders are waiting for a breakout above resistance or a breakdown below support. The second type is tight compression. This happens when the trading range becomes smaller and smaller over time. Volatility decreases as price gets squeezed into a tighter area. These situations often create pressure that can lead to a strong expansion move once the range finally breaks. The third type is a choppy range. This is when price repeatedly breaks above and below key levels but fails to continue. These false breakouts trap traders who enter too early, only to see price quickly reverse back into the range. The fourth type is flags and pullbacks. These are short periods of consolidation that happen during an existing trend. After a strong move, the market may pause and create a small range before continuing in the original direction. Understanding consolidation is important because these periods often create the conditions for powerful moves. During consolidation, liquidity builds around important technical levels. Many traders place entries and stop losses near these areas, creating clusters of orders that can fuel the next move. Consolidation also traps impatient traders. Those who enter before confirmation often get caught in false breakouts and reversals. Another important factor is volatility. After volatility contracts during consolidation, the market often experiences expansion. This is why many of the strongest SPY moves happen immediately after a consolidation pattern ends. When analyzing consolidation, there are several things to watch. First, pay attention to the range boundaries. Identify the key support and resistance levels where price has repeatedly reacted. Second, look at how long price has been moving sideways. In many cases, the longer the consolidation lasts, the more significant the eventual breakout can become. Third, watch for false breakouts. A quick move outside the range followed by a strong rejection back inside often signals that the breakout was not real. Finally, focus on the expansion move. A true breakout is usually supported by momentum and confirmation that price is actually leaving the consolidation area. One important reminder is that consolidation does not predict direction. It does not tell you whether SPY will break higher or lower. Instead, it shows that the market is building pressure and preparing for a potential larger move. The direction should always be confirmed through market structure, support and resistance levels, and strong breakout confirmation. The key takeaway is this: consolidation is not inactivity. It is the setup phase for the next major market move. Learning to recognize consolidation patterns helps you avoid low-quality trades in choppy conditions and prepares you to focus on higher probability breakout opportunities.